lie, gang, this shit looking real bad. Ain't gonna lie, gang, this shit looking real bad. Real bad. This shit looking real funky, funkadelic. Yeah, boy. Everything. Boy, that's crazy. Dang, that's crazy. I'm sitting here tripping. Watch that happen. That's crazy. Mm, it would make sense for it. I ain't gonna cap. This looking spooky. I wanna know. Uh, that's so unfortunate. That's so unfortunate. I put this high, super high leverage short in on XRP just now. Super high leveraged. A super high leveraged short on XRP. And since I've put that super high leverage short on XRP, obviously you see a green candle. That's so unfortunate. I hate when things like that happen. Man, what? Risk of getting liquidated super high right now. But when I see a little bite like that, I like to bite it out, take another bite out of the apple. Anyways,
anyone at risk or no one dies, and the answer I just
Yeah, but if you answer any
I needed to. I wanted to see this video.
Yesterday in 3 waves, you know, from the Wednesday low here all the way up to round about $83,500, and now we are in some kind of a pullback. The extent of the pullback is now important. We need to observe that in really yeah, we have to pay a lot of attention to it, essentially. So the micro support region I shared with you in the previous update is still holding. It's just a zone to watch. Basically, what I'm trying to say is that as long as we're holding above 79,518, here really on the 15-minute chart, we could get one more high. That's only one more high, however, in wave C of 4. So this could still be a wave 4 bounce with another low to come. At the moment, I'm just tracking this as a 3-wave move to the upside, right? So when we get 3 waves up, then we don't have a full confirmation that a substantial low has formed. I would need to see more confirmation.
It looked
How
like
could we
it
get
made
that
a head and
confirmation?
shoulders
Well,
pattern right here.
depends. You know, if we do this, 1, 2, 3, 4, 5, then we have 5 waves. That would be a level of confirmation, but we are far away from that. Or we form only 3 waves up, and that one more high that I said would be included in that. It would still just be a 3-wave move from an Elliott wave point of view. If we only get 3 waves up, we could still watch for a corrective pullback next, basically one that can hold a higher low, but it's not, you know, we can't expect it. There's a fine difference. If the market forms 5 waves up from a low, then we can expect that the next pullback is going to be corrective and it likely forms a higher low. If the initial move up is only in 3 waves, then probabilities are really, really balanced. But still, I will, depending on what happens now, I will provide support for red wave B, which would be our pathway for higher prices, should we get some kind of a topping confirmation there, a local top. So what that means is, at the moment, we are still holding above the upper micro support. So there's no confirmation that a substantial top has formed here. Yeah, we can still keep the door open for one more high, even though it's kind of not very high confidence. I mean, the structure looks a bit messy. It's already quite a deep pullback. I think Ethereum is already about to break its support, so it's not impressive. However, we have no confirmation of a top until the 50% retracement breaks. If that breaks, or after the next high, we can watch for the structure of the next pullback. If it's corrective and forms a higher low, that could be our setup for higher prices into the mid 90K region. I tried to explain that in the last video in much detail. Really, nothing can be added to that. But obviously, for those who are new now, just wanted to explain that. At the same time, if the move to the upside remains a 3-wave move, it remains likely to get another low in the 72 to 73K area. What I'm trying to say is once we start the next larger pullback, there will be a key support level that will distinguish bullish momentum from bearish momentum. At the moment, this is just a wait and see location. Yeah, I think the next pullback after the next high will be important. Or if we now break above break below micro support, yeah, then it will already be important because it indicates that at least a local top is in. But there will be a level, typically the 78.6 retracement measured here, yeah, this distance measured, and that will be the pivot between, hey, we go higher in a corrective bounce,
like
and
right
one more low is coming. So for now, I think this is just wait and see. Even just one more high is. So for now, I think this is just wait and see. Even just one more high is probably not going to be. I mean, you know, from what we can expect, at least it might just be one more high. So we'll see. But deep in support. I mean, still good reward to risk ratio here for those who are trying to trade one more high. But overall, as I said, probably more of a wait and see location. The support levels are very well defined, but the structure to the upside doesn't impress me really. There are only a few cryptocurrencies that have formed a micro 5-wave move up after the Monday low. Bitcoin is not one of them. It's only a 3-wave move up. And see, we are still holding below our signal line here at $83,800. I'll keep you updated. Hope you liked the update. If you did, please hit the like.
Yeah. I mean, it's getting real here because obviously this is a little area of resistance right here in that. Oh, but I mean, let's see. Hold on. Let me do that. Let's 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 draw us a little fib real quick. Let's see where we pop up with. 15-minute. I'm gonna go from this low this 74 to this high. At 83. And what we see, let's see here. Oh, I done zoomed in on the whole daggone thing. Give me that. Yeah. So, man, what? They be making life so much difficult. See, I don't got 79, but anyways, I could be off on my. Oh yeah, we want the top. We want the tippy top. And then let's make sure we got the bottom bobs. I don't want to be off. I want to get as close to precision as we can possibly get here. See. Oh. Let's see here. We got 78, 115. We fighting 50%. 79, 7. That was a Okay. In a 3 minute. Let's see what these guys are doing. What the big boys are doing. See, the big boys is bounce. I wonder if the idea is to fill this gap. I would think some kind of news would have to come out. What are we talking about today? No. Let's go. Let's get some news, baby. Let's get some news update. Oh, that's a day ago. President Trump in the White House. Terrorist reversal. Yeah, so everybody watching this cabinet thing right now.
And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries. I look forward to it.
Mr. President, China retaliated today by reducing the number of American films that can be shown there. What's your reaction to them now targeting cultural exports from the United States?
I think I've heard of worse things. Yes, please.
Also on China, the Ukrainians say they have evidence that Chinese soldiers have been found fighting for the Russians in Ukraine. Can the U.S. verify this? And if so, what does the U.S. plan on doing to China to counteract that?
We'll look into it, but I think beyond that, we're really looking to get that war stopped. They're losing 2,500 and even more than that young people a week. They're Russian and they're Ukrainian. They're not American, but they're people. And we're seeing if we can get it stopped. And I think we're making progress. I appreciate the ballerina who was released. That was at the request of a very good friend of all of ours, actually. Dana White called me and he said it's the friend or the relationship of one of the fighters for UFC or one of the fighters. And Dana's an incredible guy, and we spoke to President Putin about it, and they made a deal. They released the young ballerina, and she is now out, and that was good, so we appreciate that. We hope that we're going to be able to make a deal relatively soon with Russia and Ukraine to stop the fighting. It's so senseless. It's such a horrible thing. It would have never happened if I were president, but it did happen, and we were given that card, and I think we're going to get it. I think we're going to get it stopped. Got to get going. We got to get it. We have to move it faster. Likewise with the hostages, we're making progress. There's 59 hostages, but only 24 of them are living, and that's the way it's been presented to me by the mothers of some of the dead, mothers and fathers of some of the dead hostages, and they want the bodies of their baby, as they say, their baby, their young boys. They want them back as much as if they were alive. It's amazing, because when I met the hostages 2 weeks ago here, I couldn't believe what they had to go through, by the way. But when I met them, they said, yeah, there's 59, but 24 are living. And they actually consider, I guess if you're a parent, you do consider it this way, that the remainder who are dead, the 24 that are alive, the remainder that are dead, they want them back just as much as they would want them back if they were alive. It's
housing costs cool. And so the government data showed us that shelter costs rose 4% on an annual basis. And like you said, that is the slowest pace since November of 2021. Now, on a monthly basis, housing costs ticked up by 0.2% last month. Now, remember, there are two components that economists pay very, very close attention to and that hold the biggest weight in the shelter figure. And that's owner's equivalent rent, OER. That's the hypothetical rent that you would earn if you were a homeowner renting out your property. And so OER came in at a 0.4% gain last month, breaking the 4-month streak of a 0.3% monthly gains. And rent, which lags real-time data because the government collects this rent data twice a year, which causes the lag in the index. So rents rose 0.3% in March. And so some economists say that shelter dynamics really vary by region and by state. And we are seeing some elevated prices in the major cities.
So if the U.S. does experience a longer-term downturn or even a recession that we've heard some economists talking about as well, how could that affect the housing market?
A recession would mean less people are unemployed, which means that would be a pullback in buyer appetite. Less buyer demand out there would put pressure on home prices. And so some economists say that some regions might see price pressures than others. Like in the South, we could see a bigger drop in home prices since there's a lot of inventory out there. In the Northeast, it's unlikely because there's an undersupply out here. So on the new home market front, home builders could pull back because tariffs will increase their material costs. We've already seen that. And lastly, a recession would lower mortgage rates, but for painful reasons, Brad.
Yeah, and the employment situation certainly is one of those. As in past recessions, we've typically seen employment pull back, and therefore unemployment rate rises, and that's a larger consideration for the housing market as well, and some of those prices you were laying out. Danny, thanks so much for taking the time. It's Housing Week on Wealth, and we have the Home Buyer's Playbook with everything that you need to know about every step of the home buying process, from the planning stages to the closing to the first year of your home ownership. So today, we're walking you through that closing process. Joining me now, we've got Tiffany Weber, Thomas & Weber Managing Attorney. Let's start with inspections here. What type of inspections should home buyers be getting?
The thing to know about inspections and appraisals is that most home buyers are only going to purchase a home 2, maybe 3 times in their lives. So this is not the time to skimp out. So budgeting for all of the relevant inspections are extremely important. And those inspection reports can do some important things for you, like helping you negotiate repairs. And if a seller doesn't agree to pay for repairs, at least you know what to plan for repairs that you may need to make later. Now, when it comes to the types of inspections, the most obvious one is a general home inspection. And this is something that, a home inspector will come and take a good look at the property, make sure that it's structurally sound, that it's safe, and that the main systems are in working order. Things like your heating and air, electrical systems. Those are the things that a home inspector is looking at. But depending on the property type, you may need some other things. You might need a septic inspection or a well inspection if you're not on city water and sewer. more. Depending on the area that you live in, radon is something that you have to look at. There could be pest termite inspections that either are things that you decide to do, or depending on the type of loan, your lender may require that you get that type of inspection. And a property survey is a huge one.
Just in the last few moments, the BBC has confirmed that US tariffs against China add up to 145%. That is on top of, that is including the existing 20% tariffs that were already imposed on the country at the beginning of the year. And also, after yesterday's huge rally on Wall Street, today we are seeing a very different picture. Share prices falling on the US stock exchange as uncertainty continues over the US trade policy. The Dow is down 3.4%, the S&P 500 down 4.2%, and the Nasdaq is down 5%. Trading, however, in Europe and Asia, though, saw prices surge. So let's talk to our correspondents in Washington and in New York. Jake Kwon joins us first. And Jake, we've got this clarification from the White House as to the tariffs that China face. Just talk us through what we're learning, because initially we'd thought that China was on 125% tariff, already eye-watering, but we've had some kind of clarity now.
He looked like he's from China.
Yes, I mean, this 145% is the clarification from the White House today. The BBC finally has that number now. But there was a bit of a confusion earlier because, yes, as you say, Mr. Trump had tweeted earlier, put it on his Truth Social earlier, that the tariff rate on China will be 125%. So now the White House has clarified that, yes, there is the existing 20% that Mr. Trump has slapped on China due to what he accuses China of is letting fentanyl flow to the U.S. So now we have the 145%. But I want to point out that this is kind of a telling of how much confusion and still uncertainty around this tariff announcement. Even in the Congress here, we saw earlier the Republicans and the Democrat senators talk about this tariff issue, and there seems to be an amazing amount of confusion. Let me just read you one quote from Republican Senator Ron Johnson, and he was saying, "I still don't know what his total strategy is," referring to Mr. Trump. "I don't know what the end game is here." And Democratic Senator Elisa Slotkin, she was saying, "I'm just trying to understand what the hell is happening." And it seems that there's even confusion amongst the White House, amongst the staff of Mr. Trump. Yesterday, we saw Mr. Jameson Greer, who is Mr. Trump's top trade official. He was testifying in front of the Congress. And as he was testifying for hours, he's appeared to be unaware of this 90-day pause that Mr. Trump has announced, and that led him to being berated by one of the Democratic politicians, saying that, hey, your boss seems to know something that you don't. So all these uncertainty, it looms over what the market is going to do for the next 90 days.
Yeah, and on that, let's cross over to Erin Delmore and have a look at what the markets are doing. Jake, thank you very much, because Erin, yesterday we saw that absolutely huge rally, that surge upwards. Today, however, the markets are not looking so good.
Right, and that's a reaction to the sizable tariffs that remain in place on U.S. imports from China. As you said, stands at 145%. 20%, the administration has said, is in response to China's handling of the fentanyl crisis, and an additional 125% put into effect yesterday. Now, that makes investors uneasy, and we're seeing it play out on Wall Street. The Dow is down nearly 1,700 points as we speak. That's down 4.14%. The S&P down closer to 5%. The Nasdaq down more than 5%, in fact, about 5 3/4. But what we need to do, as much as we can talk about the historic rally yesterday on Wall Street, is actually take the numbers back to April 2nd, which is when President Trump announced his tariffs. If we go back to that mark, the S&P is down around 6%. So as much as we can talk about this roller coaster ride that we've had in the last weeks, and yes, the S&P landed above 9% yesterday. That's a one-day high since 2008. The Dow, a one-day high going back to as far as March 2020. The Nasdaq saw its best day since 2021. Yes, all banner numbers, but put it into context with what we've seen the last week, and the S&P, that broad 500 company index, is broadly down.
Erin, as always, thank you very much. Ellen Delmore there, our North America business correspondent. Also, our thanks to Jake Kwon joining us from Washington on the very latest there. And just a line coming from the former US Treasury Secretary Janet Yellen, who is saying that the threat, the instability from the falling of the markets and the falling prices for the US Treasury debt, that is, of course, the bonds, that was the reason she reckons why Donald Trump then created this pause. Of course, we're hearing from the White House that this was always part of the plan. So a little bit of confusion, and not least with the tariffs on China. A lot to discuss. I'm pleased to say that our economic correspondent, Andy Verity, joins us now. And Andy, we were hearing about that, just confusion there. The saying goes, markets hate confusion.
Yes.
But that's the messaging we're getting.
It's mood swings, isn't it? We have this sudden euphoria overnight, and then you're hit by this sobering realization in the hangover of the next day that you still have, even if you don't have quite the multilateral trade war that Trump was talking about a few days ago, a bilateral trade war on a scale we haven't seen in decades with the US and China, and all kinds of uncertainties facing the auto industry, facing the likes of Canada and Mexico, who still face 25% tariffs. Basically, all kinds of uncertainty. And anyway, the trade war has just been postponed for 90 days. He hasn't cancelled it.
Exactly, and that's really important just to keep stressing there. Just we saw that the Wall Street has opened a little bit lower. There's still a lot of angst, I guess. Europe, though, they were looking a little bit more comfortable today. So what do we read into that comparison?
Well, I mean, I think you have to look at the timings of the various announcements. The markets in Europe have been playing catch up for most of the day, but with some trepidation, because even as they were looking at the S&P 500 that covers the shares of the top 500 companies listed in New York, going up by 9% yesterday, they weren't actually edging up by as much because they knew that something bad would come today. And they were right. You know, the traders were predicting that there'd be less of a performance on the American markets today.
A cold wind cuts through the ragged tents of Hooverville. A mother huddles over a makeshift stove, stirring a pot of watery soup. She remembers the radio's advice: stretch the food, make do. She tries her best, but she knows it won't be enough. Not for her children, not for her husband. Standing miles away in a bread line, his once proud suit now caked in dust. This was America in the Great Depression, a nation brought to its knees. And all this devastation was caused by something you weren't expecting: tariffs. Or was it? Did tariffs really trigger the worst economic disaster in modern history, and could they do it again? We're breaking it all down on today's episode of The Infographic Show. Did tariffs really cause the Great Depression? You've probably heard of the Great Depression. Everyone has. Stock market crash, bank failures, millions unemployed. By 1933, 1 in 4 Americans was jobless, and it wasn't just factory workers or farmers. Even doctors, lawyers, and upper middle-class professionals saw their incomes plummet by up to 40%. Families who once lived comfortably suddenly found themselves struggling to survive. Their savings were wiped out, their futures uncertain. It was a time when make do or do without wasn't just a saying, it was a survival strategy. Families stretched every meal, patched and repaired old clothes, and walked miles instead of driving. Because with unemployment at record highs, owning and fueling a car was a luxury few could afford. The financial strain tore at the very fabric of families and communities. Divorce rates dropped, but abandonment skyrocketed. Men, ashamed and frustrated by their inability to provide for their families, often disappeared without a trace, leaving their wives and children to fend for themselves. To understand how things got so bad and what role tariffs played, we have to go back, way back, and not just to 1929 when the Great Depression began. No, we're talking about the depression that started it all, the one history barely remembers, the Forgotten Depression. The Forgotten Depression lasted just 18 months, from January 20th to July 1921, but it was brutal. The U.S. stock market tanked by 47%, and corporate profits plummeted by over 90%. Unemployment hit nearly 12%. It was just 1.4% during World War I. In the aftermath of this war, the U.S. faced a tricky transition. Factories shut down, 1.6 million soldiers returned home to flood the workforce, and inflation soared. In response, the government slashed spending by a staggering 75% and hiked interest rates to a steep 7%. The result was a 32.5% collapse in industrial production, the worst in history at the time. Prices plunged over 15%, and businesses failed en masse, leaving millions struggling to survive. The real turnaround came when President Woodrow Wilson cut federal spending by 65%, from $18.5 billion to $6.5 billion. This austerity helped stabilize the economy and eventually fueled the Roaring '20s. By March 1921, Warren Harding had taken over, and his presidency was marked by important change: the return to higher tariffs in the U.S. The U.S. has had a turbulent relationship with tariffs. One moment it's championing free trade, and the next it's slapping high tariffs to protect domestic industries. It's an economic roller coaster, swinging between protectionism and open markets, depending on the political and economic climate. Protectionism refers to government policies that restrict international trade. Think of it as putting up a fence around your country's economy to shield local businesses from foreign competition. That idea is simple. Limit imports and domestic industries have a better chance to thrive. Imports can be restricted in several ways. Tariffs are arguably the most common among them. Tariffs are essentially taxes on imported goods that make foreign products pricier, encouraging people to buy local instead. America's early days were heavily marked by protectionism. However, in the late 19th and early 20th centuries, the U.S. was riding high on relatively free trade, with an understanding that international commerce made large-scale wars too costly. The Underwood-Simmons Tariff of 1913 was the one to break the tradition of protectionism by lowering tariffs and introducing an income tax. This was a bold step toward free trade, but it didn't last long. World War I put nations, including the U.S., straight back into a protective mindset. By the time the U.S. emerged from the war, the political landscape had changed. European economies were recovering, and U.S. industries were facing new competition. American farmers who had been selling crops to Europe during the war were now losing those markets as European agriculture bounced back. To protect American industries and farmers from competition, the Emergency Tariff Act of 1921 was passed. But that was just the beginning. The real game changer came in 1922. During Harding's presidency, it was the Fordney-McCumber Tariff Act, which raised tariffs above levels seen in 1913. This law wasn't just about higher rates. It also gave the president the power to adjust tariffs by as much as 50% to balance domestic and foreign production costs. The goal was simple: protect U.S. industries from foreign competition. But there was a catch. The Fordney-McCumber tariff had an unintended consequence. It crippled European exports to the U.S. With fewer American dollars flowing in, war-torn nations struggled to pay off their debts, deepening economic tensions. Instead of helping the global economy recover after World War I, the tariff made things even worse, creating friction between the U.S. and its allies, and slowing down Europe's post-war rebuilding efforts. Meanwhile, in the U.S., tariffs kept creeping up through the 1920s. These increases had a major impact on global trade, creating a skewed relationship between the U.S. and its trading partners. By the early 1930s, the world had fully embraced protectionism, and the U.S. had set the stage for the trade battles that would shape the global economy for years to come. This brings us to the very beginning of the Great Depression, a moment when the world seemed to spiral into chaos. The 1920s had been a decade of wild growth in the U.S. These roaring 20s were like a fever dream. Everything was booming: new cars, radios, household appliances. Americans were buying it all. And they weren't just buying goods, they were pouring money into stocks. People were in a frenzy, jumping into the market with both feet, hoping to get rich quick, and fueling a market boom that seemed unstoppable until it wasn't. Stock prices skyrocketed. The Dow Jones Industrial Average, the stock market's key index, soared nearly 162% in just 5 years. But as anyone who's been on a roller coaster knows, what goes up must come down. And this ride was about to crash hard. And the ride would start going down in October 1929. That's when the unthinkable happened. The stock market crashed. It all started on October 24th, Black Thursday. The market began its freefall, and the panic spread like wildfire. A brief rally followed, but that was a false hope. By Black Monday and Black Tuesday, the damage was irreversible. The Dow plummeted, losing nearly 90% of its value over the next few years. The American dream turned into a nightmare for so many people. But the crash wasn't the end. It was just the beginning. Once the market collapsed, everything else followed. The economy froze, banks failed, businesses went bankrupt, people lost their jobs, consumers, seeing their wealth vanish, simply stopped buying. Factories and stores shut down, the whole country ground to a halt. And let's not forget the farmers. They'd already been struggling with overproduction after World War I. Crop prices were falling and they had debts they couldn't pay. It was a perfect storm, and it was only getting worse. Then came the fateful decision from the U.S. government. President Herbert Hoover, who had already enacted several major policies, decided to sign the Smoot-Hawley Tariff Act into law in 1930. The Smoot-Hawley Tariff Act was often called one of the most catastrophic acts in congressional history. And that is not just political rhetoric. That is straight from the official U.S. Senate website. When even Congress admits that they messed up, you know it was bad. But how did the Smoot-Hawley Tariff Act earn such an unflattering reputation? Well, it didn't happen by accident. This was a slow-motion train wreck years in the making. It was the culmination of years of escalating protectionism, political maneuvering, and let's be honest, a whole lot of economic short-sightedness. We've already talked about tariffs being a favorite tool of policymakers looking to shield domestic industries from foreign competition. But compared to what was coming, those earlier increases were just a warm-up act. When the Great Depression came, everyone in Washington was panicking. Desperate for a fix, lawmakers turned to an old familiar trick: tariffs. And that's how the Smoot-Hawley Tariff Act came to be. The bill was originally meant to help struggling farmers by raising duties on agricultural imports. But as with most things in politics, it didn't stay simple. Lobbyists for various industries saw an opportunity and jumped in, tacking on protectionist measures for all sorts of products. By the time the bill was finalized, it wasn't just about farming anymore. It was a full-scale tariff hike on over 20,000 foreign goods. It's no surprise that roughly 1,000 economists literally begged President Hoover not to sign it. But despite his own reservations, Hoover went ahead anyway, officially signing the Smoot-Hawley Tariff Act into law on the 17th of June, 1930. But other countries weren't just going to sit back and take it, and that's the thing about tariffs. They often come with unintended consequences. And so Smoot-Hawley ignited what economist Chris James Michener called the mother of all trade wars. 9 countries, Argentina, Australia, Canada, Cuba, France, Italy, Mexico, Spain, and Switzerland, retaliated almost immediately with tariffs directly targeting U.S. goods. Canada's response was particularly felt. After all, the country was America's biggest trading partner at the time. In 1929, 18% of all U.S. exports went to Canada, and 11% of U.S. imports came from the country. That economic relationship was obliterated almost overnight. Initially, the Canadian Prime Minister at the time, William Lyon Mackenzie King, slapped tariffs on just 16 American products. But when R.B. Bennett took over in 1930, he cranked up the pressure. Canada raised tariffs even further on U.S. goods, while simultaneously cutting tariffs on roughly 270 products from the United Kingdom and its dominions. By 1932, Canada hosted a massive trade summit with the other British territories, laying the groundwork for a trade bloc that actively excluded the U.S. Essentially, America's protectionism pushed Canada right into Britain's arms. Canadian exports to the UK surged, especially in agriculture, the very industry Smoot-Hawley was meant to protect in the US. But this was just the start. A total of 25 countries would eventually strike back with tariffs of their own. Countries already struggling from the Great Depression suddenly faced even higher barriers to selling goods to the U.S., making an already bad situation worse. U.S. exports to retaliating nations fell by 28 to 32%. Even countries that didn't retaliate still cut U.S. exports by 15 to 23%. Global trade collapsed, dropping by 66% between 1929 and 1934. One country hit particularly hard was Germany. Already drowning in debt from World War I reparations, Germany relied on exports to earn the money needed to pay its bills. Smoot-Hawley cut off one of its key revenue streams, worsening its economic crisis. Nobel Prize-winning economist Paul Samuelson described it best. Cynics were delighted at the spectacle of a country trying to collect debts from abroad and at the same time shutting out their import goods that could alone have provided the payment for those debts. In other words, America wanted its money but refused to buy anything in return. Germany's financial collapse didn't just deepen its suffering, it paved the way for Adolf Hitler's rise to power. With the economy in ruins and desperation at an all-time high, extremist voices suddenly didn't sound so extreme. As businesses crumbled and unemployment soared, Hitler's promise of economic revival and national strength became terrifyingly appealing. Less than 3 years after Smoot-Hawley was signed, Hitler was the Chancellor of Germany. But the backlash against Smoot-Hawley wasn't just economic, it was also political.
I ain't gonna play with it. I gotta get gas. Do I need gas? No, I think I got gas. A little bit. Enough to get me to work. Man. You already paid my lunch. Tragic. I will be starving today. Gotta go to work.